Many people struggle with taking profits, either too early, too late, or worse, round-tripping a winning trade into a loss. And this happens when fear, greed, hesitation, or poor planning stop you from locking in gains at the right time. Profits aren't real until realized. That green P&L can vanish in an instant if you hesitate. So, stop fumbling the bag. If you want to survive, mastering profit taking is key. Before we dive in, please remember that none of this is financial advice. This video is for educational purposes only, and we're not telling you what to do with your money. Always do your own research before making any investment decisions. Now, bear with me a little as we go through things that may be obvious to many of you, starting with what taking profit is. Now, as the name suggests, taking profit is the process of securing gains by closing an active winning position. Now, this sounds simple and obvious, but it's actually one of the most overlooked aspects of trading. A solid plan for entering trades is important, but your exit strategy is what will determine your long-term trading success. You could time the market perfectly and nail every single entry, but none of it matters if you keep giving back profits to the market. Losses are inevitable in trading, so consistently booking profits provides you the cushion to fight for another day. And without discipline in taking profits, you risk running out of capital before you have a real shot at success. So, how do you take profits the right way? Now, first of all, profit taking shouldn't be emotional. It should be a decision already mapped out in your trading plan. Without a structured trading plan, you'll hesitate when decisiveness is needed. You might round trip winning trades or even see them turn to losses because you hesitated or you got greedy. And over time, this erodes your confidence and can even spiral into emotional trading, which is a one-way ticket to disaster. So a trading plan with a well-defined take-profit strategy removes these emotional hurdles and keeps trading disciplined. Knowing when and how to take profits keeps your decisions objective. So if you don't have a trading plan, make one now, and also check out our video if you need help on making one. A well-defined profit-taking strategy should take the risk to reward, or RR ratio, into consideration. Whether you're using an indicator or resistance level to set your TP level, always assess the RR ratio before entering a trade. For example, if you're aiming for a 1-to-2 RR ratio, your TP level should be twice the distance from your entry as your stop loss. This means for every unit of risk, you're targeting twice the potential reward. So why is the RR ratio important? Well, it determines your strategy's long-term sustainability. Since no trader wins every trade, the key to profitability isn't about being right, but making sure your winners outweigh your losers. Having the right RR ratio ensures your account can still grow even with a modest win rate. For example, with a 1-to-2 RR, meaning you stand to gain twice as much as you might lose, you'll only need to win 33% of trades to break even. However, if you're aiming for a 1-to-1 RR ratio, where your potential gain equals your potential loss, you will need to win 50% of the time just to break even. So a poor RR might require unrealistic win rates and makes losing streaks harder to recover from. The takeaway is that you need to make sure the reward is worth the risk. Let's explore some methods of profit taking. The simplest method is the full TP, exiting your entire position at a predefined target. Whenever you take a trade, simply set your stop loss and take profit levels, and then let the market do the work. This hands-off approach removes emotions and it builds consistency, and it's the best starting point for new traders. It also makes journaling and reviewing trades much easier since you're always tracking one clear exit instead of multiple moving parts. And many seasoned traders stick by the full TP because of its simplicity. You know, sometimes less really is more. Another method is the partial TP, aka scaling out. Instead of exiting a position all at once, you would scale out multiple TP levels. For example, you might sell 50% at TP1, then another 30% at TP2, and let the remaining 20% ride for an even bigger move. And this method gives you more flexibility. You lock in profits along the way while still keeping some exposure in case the trade keeps running. But it also adds complexity. Unlike full TP, where you secure all your profits at once, scaling out means leaving some money on the table, which can be frustrating when the market very often reverses before hitting your final targets. But it's a great approach for swing traders and those aiming for larger moves, but also requires solid planning and discipline to execute properly, because without a plan, you'll end up second guessing your exits and might end up taking profits too soon or too late. For holding positions over a longer time frame, another approach is to remove your initial investment once the trade reaches a certain multiple. For example, a 2 times gain. And this means if you've doubled your money, you sell 50% of the position to recover your original capital, and whatever remains in the trade is now house money. The benefit of this method is that it removes emotional stress. Since your initial investment is secured, you can let the rest of the position run without worrying about giving back your own capital. This is a common strategy for buy and hold investors who want to stay in winning trades while reducing overall risk in their portfolio. So for most active traders, the full TP is the way to go. It keeps things crystal clear. You take all your profits when the trade goes your way, and there's nothing to manage. The hands-off approach also means you have less risk of being tempted to overthink or tweak your exit mid-trade. For swing traders, scaling out could be a good way to balance locking in profits with staying exposed to extended moves, but even then, the full TP remains to be the benchmark to beat. Based on your trading journal, if the data you collected on your trading outcomes shows partial TP is better, go for it. But in most cases, you'll not beat the consistency of the full TP. And if you're holding for the long haul, taking out your initial investment is a great way to protect yourself while still leaving room for further gains. Whichever method you choose, stick to your plan. Define your exits before you enter a trade, set limit orders in advance, and most importantly, don't make impulsive changes to your exits that aren't part of your strategy. Besides all this, if your account is growing consistently, pay yourself. As in actually withdraw or cash out the money from your exchange and make your profits real. Just as you would with the income from a job or a business, you should actually keep some of the money that you make from your trading. This helps you to realize that the balance you see on your exchange as something real and not just a bunch of numbers flashing on a screen. And lastly, if you somehow manage to make life-changing sums of money, go change your life. Book your profits, go on that dream vacation, buy the house, retire your parents. Don't let your only proof of success be a screenshot of a P&L that you took. Well, that's all for today's video. There's definitely a lot more to taking profits than we could cover in one session, but hopefully this has given you a good starting point on refining your profit-taking strategy. If this video helped you out, leave us a like and subscribe for more guides like this. And I'll see you in the next one. Bye.